What if I told you that the next massive AI rally, one that could hand early movers gains of 30, 50, even 100%, is quietly loading up right now, and it kicks off as early as June 26th? Welcome back to Smart Stock Sam, the channel where we cut through the noise, follow the money, and give you the trading intelligence that actually moves the needle. If you are new here, hit that subscribe button right now, because today's video is exactly the kind of deep dive breakdown this channel was built for. We are tearing apart 4 under-the-radar AI infrastructure stocks: IREN, Nebius Group, Applied Digital, and CoreWeave, and by the end of this video, you will know their hidden leverage, their dilution risks, their technical setups, and exactly how to trade them through the most volatile window of the summer. But here's the thing. What if the single biggest mistake you can make right now is buying these names without understanding the landmines buried inside their balance sheets? Because while retail investors are blindly throwing money at big-name chipmakers, these 4 stocks have quietly triggered one of the most dangerous and volatile market setups we have seen all year. So stay with me, because the next few minutes could genuinely change how you see this entire sector. Right now, the AI infrastructure space is walking a razor-thin tightrope. On one side, you have the long-term anchors, and they are genuinely compelling. We are talking about massive, undeniable demand for AI computing power. These companies are signing multi-billion-dollar contracts with the biggest names in technology: Meta, Microsoft, and Nvidia. We are even seeing some of them inducted into the prestigious NASDAQ 100 index. On paper, it sounds like a guaranteed win. But here is where the tightrope metaphor becomes absolutely critical, because on the other side, you have short-term catalysts that are actively, right now, today, destroying shareholder value. To fund gigawatt-scale data centers, these companies are piling on aggressive debt financing at junk bond yields, severely diluting shareholders through at-the-market offerings, and we are watching massive insider selling that should make every rational investor stop cold. The market has been running on passive, mechanical buying momentum, but that momentum is clearing out, and what is left underneath is a set of fundamental realities the broader market has been completely ignoring. And that is exactly the setup we are going to help you navigate today. Now, before we zoom in on each company, I want to give you the 4 critical health indicators you absolutely must monitor in this sector, because top-line revenue growth is a terrible metric for judging the actual survival of these businesses. So here is what you watch. First, capital expenditure versus funding costs. You must monitor the coupon rates on their debt, because high yields threaten to completely crush future net margins, no matter how fast the top line grows. Second, customer concentration. A high reliance on just 1 or 2 hyperscalers is a severe existential risk. A single contract cancellation could wipe out the entire revenue thesis overnight. Third, insider transactions. Heavy executive selling is arguably the leading indicator of internal valuation sentiment. When the people who know the most about the business are rushing for the exits, that tells you something the press release never will. And fourth, short interest and options ratios. Abnormal put volume to open interest ratios signal that smart money is pricing in severe short-term downside pressure. If you ignore these 4 metrics, you are flying completely blind. Keep them front of mind as we walk through each name. Let us start with CoreWeave, ticker CRWV, and it is really the flagship of this entire conversation. On the surface, this company looks absolutely incredible. They just earned inclusion in the NASDAQ 100. Their first quarter 2026 revenue exploded 112% year over year, and their implied contract backlog is approaching $131 billion. These are not modest numbers. These are the kinds of figures that make investors feel like they cannot possibly lose. But here is the part that keeps me up at night. To fund a capital expenditure plan ranging between $31 and $35 billion, CoreWeave recently priced $1.25 billion in US dollar notes at a coupon rate of 9.625%, alongside 2 billion euros at 8.5%. Let that sink in. That is junk-level cost of capital. That means for every dollar CoreWeave borrows to build data centers, they are paying an extraordinarily high premium just to service that debt before they ever generate a single dollar of net profit. And you might be asking yourself, could this really threaten a company with a backlog of $131 billion? Yes. Yes, it absolutely can, because revenue is not profit. Revenue minus debt service, minus depreciation, minus operating costs, that is what actually matters, and those numbers are going to be under crushing pressure. But the debt story is only half of the concern, because the insider selling picture at CoreWeave is frankly staggering. Since the lockup expiration, co-founders and executives have sold over $2.3 billion in stock. And just recently, the chief development officer dumped an additional $57 million worth of shares. Now, think about that. These are the individuals who know the contract timelines, the construction schedules, the margin structures inside and out. And they are choosing to convert their equity into cash at current prices. CoreWeave is also currently facing securities fraud lawsuits over alleged concealed construction delays, adding a legal overhang on top of everything else. Analyst targets range from a floor of $90 from Barclays all the way up to $140 at the high end, telling you that smart money is genuinely divided. CoreWeave is currently trading around $111.29, down over 5.5% recently, and it demands extreme respect as a trading vehicle. From a pure technical trading perspective, here is how you approach CoreWeave this week. The MACD is sitting at 0.32, which technically flashes a buy, but the RSI is a completely neutral 46.15, giving us no directional conviction. Options flow shows puts accounting for nearly 47% of total volume, telling us institutional players are actively hedging their downside. The smart play here is patience. You are looking for the price to stabilize near the support zone between $105 and $108. If it drops into that pocket and holds, your exit target becomes the resistance zone at $120 to $122. But you must set a non-negotiable stop loss below $95. If CoreWeave breaks that level, the debt burden and insider selling narrative take over, and price discovery below that floor gets very uncomfortable very quickly. Now, while CoreWeave wrestles with debt costs, our next company is facing a completely different kind of crisis, a valuation that has, quite honestly, lost its mind. Nebius Group, ticker NBIS, is up an astonishing 210% year-to-date, trading around $283.61. The growth story here is genuinely breathtaking. They also received NASDAQ 100 inclusion on June 22nd. Their first quarter revenue exploded 684% year-over-year to $399 million. They are aggressively building, acquiring IREN AI for $643 million, pushing a £1.7 billion UK infrastructure build-out and landing mega contracts of $27 billion with Meta and $17.4 billion with Microsoft. Nvidia even injected $2 billion of direct equity into the company. These are world-class business development results. But here is the question that should terrify every holder of this stock. What if the growth has already been fully priced in and then some? Because the valuation warnings are blaring, Nebius is trading at a price-to-earnings ratio exceeding 100 times earnings. 100 times. And here is the part that is almost difficult to believe. The average analyst price target ranges between $203 and $235, meaning analyst consensus is actually below the current trading price. That is not a bullish setup. Layer on top of that the fact that insiders have sold over $130 million in shares recently and that 20.73% of the public float is sold short, meaning nearly 1/5 of all available shares are being bet against by short sellers, and you have an extremely volatile powder keg sitting right beneath you. What are the odds that all of that short interest and all of that insider selling is wrong at the exact same time? Think carefully before you answer. For trading Nebius this week, you need a strict two-scenario approach because the asymmetry here is extreme in both directions. Scenario A is the long breakout play. You only enter long on a confirmed high-volume breakout above the heavy resistance zone between $297 and $300. If that ceiling breaks convincingly, the initial target is $310. But you do not chase it without volume confirmation. Scenario B is the short pullback play. If a sell the news reaction triggers from the NASDAQ inclusion, your immediate support band sits between $273 and $281. If that breaks, the deeper floor does not appear until roughly $247.95. With a 20% short float, any panic selling cascades fast, and you do not want to be caught on the wrong side without a defined stop. Now, both CoreWeave and Nebius are high-profile names, but our next company has a uniquely fascinating story because it completely reinvented its identity to chase the AI gold rush. And it is paying a painful price for how it is funding that reinvention. IREN Limited, previously known primarily as a Bitcoin mining operation, is aggressively pivoting to AI cloud services. The stock is currently priced around $56.87, battered down over 5% on the daily. The upside of the pivot is undeniable: a $9.7 billion Microsoft contract, a $3.4 billion Nvidia partnership, and smart acquisitions like Nostrum Group and Mirantis. Jefferies has a buy rating with a $79 target, projecting $3.1 billion in annual recurring revenue. So with catalysts that strong, why is the stock falling? The answer is dilution. Management announced a massive $6 billion at-the-market offering. For those unfamiliar, an at-the-market offering means the company is actively selling new shares directly into the open market, into your buy orders, every single day. Every new share issued dilutes every existing shareholder. And on top of that $6 billion ATM, they also announced a $2 billion private convertible note offering. These two capital-raising events combined have completely overwhelmed any positive growth sentiment in the stock. Smart money is not debating the growth story right now. Smart money is doing the math on how much their ownership stake is getting watered down, and they are not happy. And the options market is screaming that loudly. The MACD on IREN is a definitive sell at negative 0.48. The RSI is deeply bearish at 40.79. But the real alarm bell is in the options flow. Institutional traders recently loaded up on 20,000 put contracts at the $34 strike for the June 26th expiration. That created a volume to open interest ratio of 1,666.7 times. Let me say that again, 1,666 times the open interest in a single option strike. When you see a ratio that extreme on a put option, smart money is positioned for heavy, immediate downside. If the price breaks below support at $48.18, it becomes a prime short or put entry candidate. A bounce scenario is only viable if the stock actively holds the $56 to $57 level, with resistance sitting heavily at $60.97 up to $68.13. This is not a stock you trade casually right now. Which brings us to our final name, Applied Digital, ticker APLD, and this one tells a story about concentration risk that is almost too stark to believe. Applied Digital is up nearly 90% year-to-date, trading around $45.20. The fundamental catalysts are genuinely enormous: a $5.2 billion 15-year lease at Delta Forge, 2, and a $7.5 billion lease at Polaris Forge 3, with revenue growth of 139% year-over-year. On those metrics alone, this looks like a rocket ship. But here is the structural problem that should stop you cold. A staggering 90% of their contracted revenues are tied to just two hyperscaler customers, one of which is CoreWeave, the very company sitting under $31 to $35 billion in planned capital expenditure and junk-level debt costs. What do you think happens to Applied Digital if CoreWeave hits a liquidity crunch? Despite that revenue growth, Applied Digital remains deeply unprofitable, posting a net loss of $101 million last quarter. They recently issued $1.59 billion in 7% notes just to keep the build-out funded. And perhaps the single biggest red flag of all, Nvidia recently completely exited its $177 million equity stake in the company. Nvidia, the company driving the entire AI infrastructure narrative, walked away from its direct investment in Applied Digital. That is not a subtle signal. Analyst opinions are completely split. Northland Securities has a buy at $82, while Zacks rates it a strong sell, citing heavy debt and a bloated 16.95 times forward price to sales multiple. When analysts are this divided, the only safe anchor is the technical levels. Applied Digital's options volume is currently subdued relative to the other names, which tells us the market is not making a strong directional bet right now. Technical indicators are mixed, with the MACD flashing buy, but the 5-day moving average flashing sell. When the data is this conflicted, you execute a strict technical range trade and nothing more. Do not buy it in the middle of the range where you have no edge. Wait for a drop to the established support level at $38.35. If it holds there and bounces, you take profits mechanically near resistance at $51.39. No greed, no holding for a breakout. Without an extreme momentum catalyst, the range boundaries strictly dictate the play. Now let us zoom out and look at all four of these companies together, because there are three macro structural risks threatening the entire sector's short-term valuations. The first is cost of capital. When companies like CoreWeave are issuing debt at 9.625% and 8.5% yields, that is a warning sign that the market views these businesses as high-risk borrowers. Rising capital costs will severely compress future net margins regardless of top-line growth. The second risk is hyperscaler dependency. Applied Digital, relying on two clients for 90% of revenue, and IREN, entirely tethered to Microsoft and Nvidia, creates a terrifying domino effect if one contract falls through. And the third risk is the most uncomfortable of all, the insider exodus. CoreWeave insiders have dumped over $2.3 billion in stock. Nebius executives have sold over $130 million. Nvidia has walked away from Applied Digital entirely. When the people with the deepest inside knowledge of these businesses are converting their equity into cash at current valuations, every retail investor needs to pay attention. And the timing of all of this aligns perfectly with a mechanical market event that has been artificially inflating prices for months. Nebius ran up 210%, and CoreWeave surged because passive index funds were required to front-run and buy shares ahead of their NASDAQ 100 inclusions. Billions of dollars of mechanical buying flooded into these names regardless of valuation. That was the buy the rumor phase. Then, on June 22nd, both stocks traded down on their actual inclusion dates, marking a local sentiment top. Now, entering the post-inclusion reality window between June 23rd and June 26th, that mechanical buying has completely cleared out. What is left is raw price discovery, reverting to fundamental metrics. Stretched price-to-earnings multiples, high short interest, crushing debt burdens, and dilutive equity offerings are all now visible without the artificial cushion of index front-running. This is exactly the window where disciplined traders make money and undisciplined traders give it back. Before we wrap up, here is the important financial disclaimer you need to hear. Everything discussed in this video is strictly for educational and informational purposes only. Nothing here constitutes financial advice, investment advice, or a recommendation to buy or sell any security. All trading and investing involves significant risk, including the potential loss of your entire principal. Past performance does not guarantee future results. Always do your own due diligence and consult with a licensed financial professional before making any investment decisions. The analysis presented is based on publicly available information and technical indicators as of the production date and is subject to rapid change. Smart stock. SAM and its creators may hold positions in the securities discussed. Market conditions can shift instantly, and any trade setups covered here carry real risk of loss. So here is the bottom line. Yes, the pivot to GPU-heavy data centers has unlocked genuinely historic top-line growth across all four of these names. The AI infrastructure build-out is real, the demand is real, the contracts are real, but short-term valuations are highly, dangerously vulnerable right now. Massive insider selling, severe dilution mechanics at IREN, and junk yield debt issuances at CoreWeave represent clear and immediate headwinds you cannot ignore. Your tactical playbook for the next 72 hours is simple. Hedge your downside risk first, respect technical levels over macroeconomic hype, and wait for confirmation before entering overextended names like Nebius. Execute on defined support and resistance zones. The $105 entry for CoreWeave, the $38.35 support for Applied Digital, and require a confirmed high-volume breakout above $300 before you ever consider going long on Nebius. The AI gold rush is absolutely real, but if you do not manage risk on the infrastructure side, you will be the one left holding the bag while the smart money quietly exits. Now I want to hear from you, and here is today's big question. Do you think the massive insider selling at CoreWeave and Nebius is a genuine red flag signaling a deeper sector correction ahead? Or do you believe these executives are simply capturing peak liquidity gains while the long-term AI thesis remains fully intact? Drop your honest take in the comments below. I read every single one, and I reply to as many as I can. If this breakdown gave you real value today, please hit that like button right now. It genuinely helps this channel reach more investors who need to hear this kind of analysis. And if you are not subscribed yet, hit subscribe and ring that notification bell so you never miss a setup like this one again. If you want to go even further and directly support the work we do here, consider sending a super thanks using YouTube's support feature. It means everything, and it keeps this level of research coming week after week. But here is what I really want you to know before you click away. Smart stock. SAM now has an exclusive membership community. And if you are serious about leveling up your investing and trading game, getting access to deeper analysis, real-time trade setups, and a community of like-minded investors who are working every day to make smarter, more disciplined decisions with their money, then joining the membership is the single best move you can make right now. The link is right below this video. Come join us, because the market rewards the prepared, and inside our community, we make sure you are always prepared. See you in the next one.